Holy smokes, everyone. What an absolutely wild week it was this week in the markets. And in today's video, I'm going to be going over what happened in the markets last week and some thoughts on what I think is going to be coming ahead. Because a lot of people think that the market's, just going to rebound soon. It's going to surge back to all-time highs. But what I think is actually going to happen is the markets may not recover for decades. Okay? And also, what I'm saying now, or what I think now, is that cash is no longer trash, and cash is going to reign king again very, very soon, if it is not already. Okay, so first things first, what happened on the close on Friday? So, we should actually go back to the start of the week, Monday, Tuesday. Monday, Tuesday, we had some huge rallies, the two biggest day rallies since March 2020. Now, what you have to know is, during the biggest crashes and the worst bear markets, we see the biggest rallies. And unfortunately, what happens is, I'll see a lot of people, especially in the comments, the markets will be going down for months. None of the fundamentals will change. Things will be looking very, very bad with the macroeconomic picture and even the technicals. But the market will rebound for one day, and then people go, oh, the crash is over. It's time to get in now. I guess there's no more crash coming anymore, Michael. I guess you're wrong. Well, people, there's something called volatility in the markets, and markets just don't go straight up, and markets just don't go straight down. Okay, it's a very bumpy road. Just like what we saw in July, we saw about July, early August, we saw about a 17% rally. And I tried to warn you guys then that that was just a typical bear market rally. The average bear market rally is around 17%. Now also, the average bear market lasts around 290 days. So we're not past this bear market yet. According to the averages, it should be late October, early November ending. But I think this bear market is going to be very, very different to other bear markets because of how much debt there is in the system this time, and how aggressive the Federal Reserve is going to have to get. Now, also what I warned about Monday, Tuesday, that this was a short squeeze. What happens in the markets is people go short when things are looking really bad. They buy lots of puts. And then the big people on Wall Street, they see how exposed people are, and then there'll be a huge trade put in, and it'll squeeze all the shorts. And people may get liquidated, and that's what causes the huge rallies as well, short squeezes. We see how that happened, with the meme stocks, and the same thing can happen with the indexes as well. But then, of course, the last few days, then those gains got wiped out, and the reason for that is we've got some new data, and you always have to be data dependent. You can make some predictions, but when the data changes, you have to change your mind. And we got some more data that proves the Federal Reserve is not going to be able to pivot. Everyone is trying to bet when the Federal Reserve is going to pivot. So if you're saying, look, I'll start investing again when the Fed pivots. When the Fed pivots, it'll already be too late. Big money on Wall Street already would have brought in. Some smart retail investors would have already brought in. Everyone is trying to predict the pivot and time the pivot before it happens. This is why we're seeing these big rallies followed by these big sell-offs, because every month they go, okay, is this time for the Fed to pivot? They'll buy. And then the Fed will come out and say, no, we're not pivoting. Or some new inflation data will come out and say, no, we're not pivoting. And we did get that. We also got the people at Federal Reserve coming out speaking, saying, no, we're not going to pivot. But we did get the jobs number. The unemployment rate actually fell to 3.5%. And it was a good jobs report. I think there was nearly 300,000 jobs created. So that's just more ammunition for the Fed, or more reason to say, look, apparently the economy is still holding up, or at least the job market is. Now, we all know the real unemployment number is much higher, but the Fed goes off these numbers. Also, we got core inflation. Core inflation came in higher than expected. And there was something huge that happened recently with OPEC. What's been happening lately is the US has been draining their strategic reserves. And, normally they do these for emergencies, but they've just been doing this to try to keep gas prices down. So, keeps the voters happy, especially with the midterms coming up. And OPEC was meant to increase production But they said, no, we're not going to increase production, we're going to cut production. And this has caused oil to spike and spike pretty rapidly. It's now at around, Brent crude's now at around $97. And a lot of people are saying that it could go back up to $110 a barrel. I think it could go even higher. And who knows, could we go back to $130, $140 during the previous run we just had recently before this huge decline? It's not out of the realm of possibilities. And the only reason why inflation has kind of moderated over the past couple of months is because gas prices have crashed. But if oil makes another rally, or gas prices make another rally, everything else is going up. Food's going up. I was looking at trading economics. The commodity prices for eggs is up 275% this year. Absolutely crazy. So if you like your bacon and eggs in the morning, you may just have to only have bacon, because eggs are going to get very, very expensive. I think just the past month it was up 93%, the commodity, the futures for eggs. So there's not going to be any Fed pivot, everyone. And this is why the markets have been selling off the past few days. Now, why I think this crash is going to be so much worse than other ones is because, one, there's so much more debt. Two, asset prices were extremely elevated for so long. It's not like we're crashing from when markets were at fair value. We were crashing when markets were extremely overvalued. Now, I see a lot of people say, well, look, the markets will always recover in 7 to 10 years. That doesn't always happen, everyone. Look at the Nasdaq. The Nasdaq, when it crashed, 77% crash, it didn't recover for 15 years from 2000. During the Great Depression, did you know the market crashed 89%? Now, that may seem like ancient history, and because it seems like humans, if something doesn't happen in their lifetime, they think, okay, it can never happen again because it didn't happen in my lifetime. No, it can happen again. Again, I'm not saying there's going to be an 89% crash, but it is a possibility if inflation goes out of control, like we're seeing in some other emerging economies like Argentina. They're expected to see 100% inflation. That's right, 100% inflation. And this is why it's so dangerous for these central banks to be pivoting. The RBA, the Reserve Bank of Australia, is a complete chicken. They've already backed down. They're already slowing their rate hikes, and they're not even at 3%. And that's causing the Australian dollar to crash. And that's what's going to happen to all these other countries that don't go along with the Federal Reserve and keep hiking interest rates. But do you also know, in the 1980s, everyone thinks that inflation is going to drop in 1 year. In the 1980s, when Paul Volcker had to lift interest rates up to 18%, it took 5 years just to get inflation back down to 4%. And then it took about another 10 years to get inflation down to their 2% target. So people thinking, that the Fed's going to lift interest rates to 4-5%, and then the next year inflation will go straight back down to 2%, then they'll start cutting interest rates. People, you need to learn from history. Again, I don't have a crystal ball, but if I did need to make a crystal ball, I would put data in from the past to give us an idea of what may happen in the future. So again, crashes in the past, the Great Depression, 2000, even it was around 1968 to around 1990, the market didn't hit its peak again. So there's been many times in history where it's taken more than 10 years. Now, again, debt's so much higher. Everyone's saying that the Federal Reserve is going to stop at 4.6%. Like I've been warning about people, they're going to have to go at least over 5%. And 5% is a critical number. When they go over 5%, we're going to see things in the financial markets break. Like what happened in the bond market in England, where they were hours away from pension funds going bust. Can you imagine that? In the US, coming on the news, announced that all people's retirement funds are gone. Everything's gone. Your 401ks are gone. In Australia, your superannuation's gone. Can you imagine what kind of depression that would make? Again, it wouldn't be a recession. It will be a depression. And people, with the way things are going, again, I think we are heading for a depression. Again, I keep saying this. If people can't afford to eat, If people can't afford to heat their home, if people can't afford to put fuel in the car, pay their rent, it is a depression. Okay. So I think what's ultimately going to happen, to put it simply, the markets are not at their bottom yet. I think we still have at least another 10 to 15% to go minimum, and then we'll have to reassess from there. And the Federal Reserve's not going to be able to pivot again. 1980s, it took the 5 years for inflation to come back down. They're going to have to keep rates high for longer. And I don't think the markets are going to rebound next year. I think it could be 10 years. We could have a lost decade, or even multiple decades like other crashes, before we see an all-time high. So what do you think about this, everyone? Thanks for watching. You're awesome. I'll see you all in the next video.